Very warm greetings to one and all who's watching this lecture. Myself, Nishi Pathak, associated with Department of Management Studies at Rajkumar Goyal Institute of Technology, Ghaziabad. I am here to deliver my third lecture related to the subject Investment Analysis and Portfolio Management, that is the first paper of the finance specialization. The topic which I am going to discuss here is trading of securities, equity, debentures and bonds. Now, in my previous lectures, we have discussed what is capital market all about, the basic information regarding to the capital market, what are the instruments, and now these instruments we are going to discuss in detail in this lecture. Then what has been the new issue market, what are the major functions that are performed by the stock exchange, what are the features, natures, the basic information all about dealing with the primary market and the secondary market that is included in the capital market. We also discussed about the financial system, as capital market is affiliated to the financial system. So, now we are going to discuss in detail the basic instruments or the most important instruments that exist in the capital market, that are used in the trading, in the investment part in the securities market. As we know, they are the equity, they are the preference shareholders, they are the debentures and the bonds. So, let's have a detailed discussion about these avenues. Before we move into the avenues, let us make ourselves very much clear about one thing, that the trading or the investment for every person differs. That means all investors are not the same investors. They all have different preferences, different options, different objectives of investment. First thing is that has to be taken into consideration is the risk factor. Everyone cannot take very much risk, or let us say everyone cannot take risk. There are certain people who are ready to take all type of risk, they are even ready to lose the principal amount that they have invested, but they are expecting high returns in future, though with the risk associated. But at times we have people who are risk averse in nature, that means they do not want to take risk. They want to invest in very traditional avenues that is not going to give them return, and at the same time there would be least or no risk involved with the investment. Second thing that has to be considered is the time horizon. I may invest just for certain weeks or for a year maximum, but there are certain people who can invest for long term. So, many a times the investment decisions, it could be in the trading, because trading of securities need a long term association with the capital market. So, whether you want to invest for short term, you want to invest for medium term or long term, has to be the other consideration. These considerations I am talking about as an investor. What does an investor think? These are not exclusively for the trading of securities. When I am talking about the time horizon, another thing I need to mention over here is what is the intention with which I am investing my hardcore savings. Do I want high profits? Yes, I can go for the trading, but I want a regular income. I need to choose another options, maybe pension funds. I need security, I need capital gains. So, what are the intentions, what are the basic objectives with which I am using my hardcore savings in the investment? When I want to earn high profits and I am ready to take risk, then yes, I would move towards the securities market. And then I would have these avenues which we are going to discuss now. So, First and the most important avenue in consideration while investing in capital market is the equity shares, right. Equity share, what is equity share? Equity share is the smallest unit of the capital of the company. That means the capital of the company is divided into smallest of the denominations. These smallest denominations are known as equity shares, and these are the main source of long term capital. Whoever holds these equity shares becomes the owner of the equity share of the company, with the proportion of the shares being held by that person. Now, let us focus on the features. We have very exclusive features associated with equity share. Obviously, they are the ones who are taking more of risk, right. So, they would always have exclusive rights that would be given to them. The first and the foremost one is they have the voting rights. All the equity shareholders have the voting rights in the resolutions that are taking place in the company, which the other options may not have. Then they are non-redeemable. Non-redeemable means they are perpetual. They do not have any maturity date. They would exist, their life would be till the life of the company, and would be matured or would be redeemed, called back only when the company winds up in the liquidation process. Then the next point says the residual income. I will cover the next point also along with it. It has residual income and also does not have any fixed dividend. So, equity shareholders do not have any fixed rate of return that they would get. The rate of return on the equity shares, or in fact shares, is known as dividend, and they are eligible for residual income. Residual income would mean the preference would be given to the debentures, maybe bonds, and the preference shareholders, and then their turn will come. And at the time of their turn, if the company has profit, it would surely be giving the profits, distributing the profits. If it does not have, it would not give any share to the equity shareholders. That is one of the peculiar feature of equity shares. But in case the company has a lots of profits left in residue after distribution and having all its obligations materialized, in that case obviously equity shareholders would be the most beneficial shareholders at that particular time. Now, another feature is that the equity shareholders have the chance of getting bonus shares. What are bonus shares? Bonus shares are those shares that are issued additionally by the companies free of cost to the existing shareholders in the promotion of the shares held by them. Right? They are not going, the company does not charge anything extra for these shares. It is a way of increasing the capital simply in simple terms. Then preemptive rights. Preemptive rights is the right issue. That means if the company is coming up with a new issue into the market, in that case that new issue would be offered to the existing equity shareholders first, and then only it could be offered to the general public. So, these are the basic features that make equity shares a very different avenue from all the other options that are available for investment in the securities market. Equity shareholders can give you tons of profit, millions of profits, and at the same time it can lead you to the losses also. It all depends upon the performance. Next we have in line is the preference shares. As the name itself suggests, preference. So, that means these type of shares have a bit of preference over the equity shares. What type of preference? That they would be paid the dividend before the equity shareholders, and they have a fixed rate of dividend. they are entitled to a fixed rate of dividend that they would get and would be preferred over the equity shareholders in payment of this particular dividend that has been specified earlier. Right. Now, when we talk about features, obviously it would not have exclusive features like equity shares, right, because obviously it is getting a fixed rate of return. Now, features is the first and the foremost one we have been discussing, that it is entitled to get a fixed rate of dividend. Then they have a preference over the equity shareholders in the payment of this. Then a fixed maturity period or provision of conversion into equity share of the company can be another feature, in which the preference shares can be redeemed at a particular specified time, or if specified earlier, they can be converted into equity shares of the same company. Now, they do not have any voting rights, they do not have any privilege of getting the bonus shares. So, that is the basic difference between the preference shares and the equity shares. Let us have the type of preference shares. When we talk about the preference shares, majorly I have mentioned three categories over here, the most prominent one. The first one being the redeemable and the non-redeemable preference shares. Now, redeemable and non-redeemable is concerned with the perpetual feature of the shares. Redeemable preference shares are those shares that can be redeemed at a specified period of time, if it is mentioned at the time of the issue. That means they have a maturity, they mature at a specified date. But if we talk about the non-redeemable ones, that means they are perpetual in nature. They would exist till the company exists. They cannot be redeemed until and unless the winding up of the company takes place. That is the basic difference between the redeemable and the non-redeemable one, based on the feature of perpetual. Next is the convertible and the non-convertible ones. Convertibility and non-convertibility is based on equity shares. Here, what happens is, there is a feature at the time of purchasing these preference shares, that after a particular time period, at a specified time period, these preference shares can be converted into a particular number of equity shares of the company. So, that is why these convertible preference shares are also known as hybrid instruments, because they enjoy the features of both. Once they would be enjoying the feature of what? A fixed rate of dividend. As soon as they get converted into equity shares, what is the feature? They do not have any fixed rate of dividend. So, that is why they are known as hybrid instruments, the convertible ones. Now, the convertibility could be fully or partially. Fully means all the preference shares get converted fully into the equity shares. Partially would be half of it or a particular ratio of it gets converted into equity shares. Next, the remaining ones could be perpetual in nature, or it could be redeemed at a particular maturity date. Non-convertible preference shares would be the preference shares that cannot be converted into equity shares. They do not have such features, or now such feature has been mentioned at the time of the issue of such shares. Then another important classification of this preference share is the participating and the non-participating preference shares. Participation and non-participation would deal with the participation in the extraordinary profits. It is not some participation in some of the issues of the company and so on and so forth. No, here the participation, we mean the participation of the preference shares in the extraordinary profits. Now, let us see what is participating and non-participating. When we talk about the participating preference shares, it is what? It has the right to participate in the extraordinary profits that are incurred by the company. Whatever dividend, the rate of dividend has been declared of them, for them, they would get additional profit apart from those fixed rate of dividend. So, they would be able to participate in that extraordinary profit. But the equity shareholders obviously would be paid first, and then the preference shares would be able to participate. The condition is that the company should be able to have sufficient funds in order to distribute them among the preference shares under the participating preference shares. It is not fixed, it depends upon the company has that profit or not. Extraordinary profit has to be the basic condition to fulfill the participating preference shares features. Then we have the non-participating. So, obviously, whatever the rate of dividend has been declared for the preference shares, they would get just that particular rate of dividend. Apart from that, any additional profit, the proportion of profit, the portion of profit would not be shared with them. That is a non-participating preference shares. So, based on the perpetual feature, we have the redeemable and the non-redeemable. Then based on the convertibility into equity shares, we have the convertible and the non-convertible, and the participation of the shares in the extraordinary profits of the company. We have the classification participating and non-participating preference shares. Let us move on with the next avenue. Next avenue is debentures. Basically, debentures and bonds are they have a very thin line difference between themselves when we consider the debenture and the bonds. So, sometimes their names are used interchangeably also. Bonds, instead of bonds we can use debentures, instead of debentures we use bonds. So, that is what exists, but we would be discussing debentures and the bonds separately over here. Now, when we talk about the debentures, debentures are a type of loan, they are the type of debt that the company has taken from the general public, right. Now, over here the rate of return is the interest. As compared, we had the rate of return known as dividend in the cases of the shares. Now, the debentures, as they have a fixed rate of interest over them. They are a type of loan or the debt that the the company has taken from the general people, the general public. All right, and debentures, normally the interest on them is paid half yearly. Now, let us have the features of debentures. The first and the foremost feature is that it is a type of loan, it is a type of debt that the company has taken, it would have to be repaid by the company. Then they do not have any voting right as such, that existed as a feature of equity shareholders. Next is that they have a fixed rate of interest that would be paid to them, and it is contractual in nature, a contract between the company who is taking the loan and the general public who is offering the loan in the form of debentures. They have a legal obligation, the company has the legal obligation to obviously pay out for this debenture, the debt that has been taken. Now, debentures always have a priority over the equity shares and the preference shareholders. That means, when the interest has to be paid out of the profits of the company, debentures would be paid first, then the preference shareholders, and then we discuss the conditions about equity shareholders, what could be the payment of the conditions of the payment of the return, the profits to the equity shareholders. So, let us have the type of debentures. Here we have 4 categories: redeemable, non-redeemable, convertible, non-convertible, that we discussed in the preference share details also. new category that comes up here is the debenture with warrants and debenture with option. Now, redeemable and non-redeemable are which debentures? Again, the perpetuality of the debentures has to be considered over here. The debentures that have a particular maturity date, they would mature at a specified date, they are the redeemable ones. But the debentures that would exist till the company exists, till the winding up of the company is processed, they are the non-redeemable ones. Then we have the convertible and non-convertible. The convertibility here is in terms of equity shares. Convertible would be the debentures that could be converted into equity shares. So, again that is why they are known as hybrid instruments, because they are enjoying the feature of the debt and the equity both. So, convertible ones easily get now this convertible ones could be partially or fully. Partially would be that partially gets redeemed at a specified date and partially gets converted into equity shares, but the things have to be specified at the time of the issue. And if we say the fully convertible debentures, the fully convertible debentures would be that get fully converted into equity shares. The number of equity shares, they get fully converted into the specified number of equity shares. Non-convertible ones cannot be converted, they would be redeemed at a particular maturity date. Now, we come to another important type of debentures, that is debenture with warrants. Certain debentures are issued with warrants. What is the feature of this warrant now? The feature of this warrant is that the holder can at any time, at a specified time, go and get itself exchanged with equity share. That means a debenture that holds a warrant, in exchange of this particular warrant, the investor, the holder can get itself the equity shares of the particular company. This right is not necessary to be practiced. If the investor is interested, if the trader is interested, he can go for this right. If he is not interested, it is okay. And if he goes for the conversion of the exchange of the warrant into equity shares, obviously the existing debentures would not get affected at all. Then we have another category, that is debenture with options. Debenture with option is the right that exists with both the parties. It is the right that exists on the part of the company and right that exists on the part of the investor also, the debenture holder also. The options that are existing with the debentures are the call option and the put option. Put option means at any time before the maturity date, a debenture holder can go and get the debenture matured before any maturity date, before any specified date. It can give back the debenture to the company. But when we talk about the call option simply means the issuing company has the right to call back the debenture before the maturity date, before the specified date. So, this is the debenture with the options, the call option and the put option. Call option that exists with the companies and the put option that exist with the holders of the debentures. Now, moving further, we have another thing, that is bonds. Now, as I told you that bonds are interchangeably used with debentures, right. Debentures and bonds have the same features, but the only difference, minute difference that they have is that the party who is issuing it, the company that is issuing it. So, when we focus on the bonds, bonds are also the long term fixed income securities, they are also existing for long term. When we talk about India, the debt securities that are issued by the government, the public sector units, they are referred to as bonds, and the issued debt or the issued loan securities by the joint stock company is known as debenture. These can be interchanged, the terms can be interchanged and used. So, what does we have in hand from the definition of the debentures and bonds? That simply we have two categories. One is the government bonds issued by the public sector companies or the government, and we have the corporate bonds that is issued by the joint stock companies. But we still have the categories in the types of bonds. They could be convertible bonds, as any other convertible avenue that we had, the debenture, the preference shares. The bonds also have the feature of getting themselves converted into equity shares. The same, they would also be, the convertible ones would be known as hybrid instruments, because they would be enjoying the feature of a debt and the equity, and they could be also on the basis of partial and full conversion into equity shares. Then we have the callable bonds. Callable bonds are those bonds that can be called back, that can be rolled back by the issuing company before the maturity date. Now, if this sudden call comes into existence, the investors of these bonds have to be compensated with the sudden call, the loss that would occur due to this sudden call. So, the callable bonds have a high rate of interest on them. They offer a high rate of interest. Now, the third category is the zero coupon bonds or the deep discount bonds. Zero coupon bonds or the deep discount bonds are the bonds that are issued at a high discount. That is why the name is deep discount, right? They are issued at a high discount, and at the maturity date they are redeemed at par. That is why they are known as deep discount bonds. They are known as zero coupon bonds just because they do not have any coupon interest rate that is attached to them. Why? Because they are issued at a deep discount. We will have the example for this. Suppose we have a bond of 1000 rupees. Now, this 1000 rupees bond, if it is a deep discount bond or if it is a zero coupon bond, would be issued as it may be suppose at rupees 600. So, issue rate is 600 over here. Now, at the time of maturity, at the time of the specified date at which this particular bond matures, it would be redeemed at 1000 itself. So, what is the earning over these shares? Rupees 400. This is the deep discount that is offered on such shares. And when we were calculating all these things, we have seen that there was no rate of interest that was involved. There was zero rate of interest that was involved. So, that is why zero coupon bonds is also the other name for these deep discount bonds. So, that was the details about the zero coupon bonds and the bonds. Now, let me conclude with my lecture. This particular lecture was dealing with the three main or the important avenues that exist in the capital market: equity shares, the preference shares, and the debentures and the bonds. So, here I conclude that these are the most three important avenues of investment. Depending upon the risk taking ability, the investor selects and also depending upon the feature of the avenues, the investors select the avenues accordingly. Thank you everyone.